All right, this video is about Module 14, which is having to do with inflation. So here we're going to be talking about inflation and what it is and how it negatively impacts some people. All right, first of all, inflation, as a reminder, is an increase in the price level. So just keep in mind that, remember what we talked about from when we talked about the business cycle. So inflation is when prices as a whole goes up. So we're not just talking about the price of one thing, we're talking about prices of everything going up. So the question is that what happens? Well, when we have inflation, it is essentially like a rat eating our money. The reason being is that our money is like we have less, because when prices of everything goes up, all of your money has less value, so it is essentially like a rat eating your money. You have less of it. So how do we calculate the inflation rate? Well, if you remember way back to when we talked at the very beginning of this unit and the very beginning of this chapter, we talked about how to calculate increases in GDP, changes in GDP. So if you remember, we talked about changes in GDP from one year to the next. We can determine the percent change by taking the GDP of year one minus the GDP of GDP of year two minus the GDP of year one, divided by the GDP year one, and that will tell us the percent change in GDP from one year to the next. Now, you're asking yourself, why is she talking about this now with inflation? Well, the reason is that when we calculate the inflation rate, we're taking the price level of year two minus the price level of year one, divided by the price level in year one, multiplied by 100. Does this sound similar? It should, because it's very similar to how we determine how much the GDP changed by. Remember, this was just GDP in year two minus the GDP in year one divided by GDP in year one. Now we're just changing it to price level. So that's going to be determining our inflation rate. Now you may ask yourself, okay, what the heck is a price level? All right, we're going to talk about that, and that's our next topic for our next video, but we will get there. So price level is going to be determining our inflation rate. Now, this is kind of a graph, and I try and get the most current that I can. The closest I got was 2012. So this is going all the way back to 1916 to 2012. So the interesting thing is this is looking at the inflation rate over the course of time. And so you can tell that, for example, way back in like 1919, inflation was like 18%, which is, you know, kind of crazy. Not super bad, but kind of crazy from the standpoint of a couple of years later, look at it drop down to negative 10% inflation. How is that possible? If you have a negative inflation, that means you have deflation. The prices are actually dropping, which is not a good thing either. Because if you are going to have prices dropping, and you have a loan, then it's going to negatively affect those people that are paying back the loan, because now you're going to be paying back the loan with money that is worth more. So deflation isn't a good thing either. Now you can notice from this graph that we have wild fluctuations for a long time, and then it kind of levels out here in the early 60s, and then we had some crazy inflation here in the 70s, but then it kind of has some, we have some, you know, fluctuations in the inflation from the 80s on, but it's not the wild fluctuations that we had way back here. And part of this, some economists may argue, would be that we got better at being able to use some of our policy tools, fiscal and monetary policy, to be able to control for inflation, but other people say that there's a lot of other outside forces that are causing that. We'll talk about why that's changed later, but I do want to show you kind of how much our inflation has actually fluctuated in the United States. Okay, so costs of inflation. There are costs associated with inflation, so those things that actually are negatively impacted because of inflation. So the first cost of inflation is what we call shoe leather costs. So to understand this is what's going on when we have shoe leather costs. This is that when inflation happens, people don't want to keep money on hand. We'll go to the extreme example. If you remember back to U.S. history and world history, after World War I, Germany had a ton of inflation, so much so it was called hyperinflation. That was crazy amounts of inflation. We're talking like triple digits. But the value of the Deutschmark at the time, which was the money used in Germany at the time, was so low that it had to take a ton of money to go to the store just to buy groceries. So as a result, people just didn't keep money on hand. They kept it in the bank. So they kept it in the bank, and then when they went to the store, they had to keep going back to the bank to be able to withdraw the money. So as a result, they wore out their shoes. That's why it's called shoe leather costs. So because they had so many times that they had to go back and forth to the bank to be able to go get their money, they wore out their shoes, and it's wasted time and effort. Remember, we talked about opportunity costs. They have an opportunity cost as far as their time, on what you could be doing with your time rather than going to the bank every single time. Now, some people argue, okay, do we still have shoe leather costs? I mean, really? Do we keep money on hand? A lot of people go and pay with credit cards or debit cards. They use plastic, right? Nobody uses cash anymore. What's cash? But keep in mind that we do have that extra time of figuring out, what are we going to do with our money? So that's what we mean by shoe leather costs. One of the other costs of inflation is what we call menu costs. And menu costs is this idea that because of inflation, we constantly have to have producers change the price that they're charging to consumers to be able to keep up with inflation. And so it takes time and money to be able to do that. And if you think about it, when you pay for something, you are looking for the price tag, right? So you're looking for, you're going to go buy a shirt or groceries or whatever, you're going to look at the price tag. And it used to be that when we had inflation, you had to have somebody actually go around and manually go and put different prices on everything when inflation happened. Do we have to do that anymore? Well, no, we have computers. Think about it. Have you ever went to go and buy something and you thought it was going to cost one thing, you get up to the register and they ring you up and then it costs something different? So whether that be better or worse, but what happened? How is it that you didn't know? Well, nobody actually changed the price tag, but they changed it in the computer. So even though they may not have to change the price tag anymore, somebody has to pay for the person that's going to put it in the computer and change it in the computer. So keep in mind, menu costs change. So this little cartoon has the waiter saying, grilled tofu salad is down an eighth, salmon wrap is up a quarter, and the goat cheese fettuccine remains unchanged, as if menu prices are like stock prices. All right. Third cost is what we call a unit of account cost. This is basically the idea that money isn't reliable. It's not a reliable way to measure things anymore. It's more difficult to be able to compare things. For example, if I told you that literally last week I actually heard somebody that said that they paid 67 cents a gallon for gas last week. You would want to know, geez, where's that? How can I get that? But you understand what that means. You understand that that's cheap. But if we have inflation, you don't have any sense of, what's up, what's down. But I don't know. Is that a good price? I don't even know. So the unit of account is this idea that we have a reliable money that we can actually determine what's good and what's bad. If we have inflation, then it's really hard to determine that. The fourth cost of inflation is this idea of tax purposes. For tax purposes, it's going to distort the profit from tax purposes. So I'll give you a little, for example. This is in the case of a house. Okay, your parents buy a house. Let's say your parents buy a $250,000 house. All right, great. Now, hopefully over time, the value of that house will increase. But you want the value of the house to increase based on inflation, but based on stuff that you're going to do to improve it. So maybe, your parents can't take out the carpet in this room, put it on hardwood floors, and, update the bathroom or the kitchen or whatever. Put an expansion in, I don't know. But those are all things that are going to add to the value of the house, okay? But if you did absolutely nothing to the house, the value of the house will change because of inflation. And if it changes too much, so let's say the assessor comes in, and the county assessor is the person that's going to determine the value of the house for tax purposes, and they look at your house, your parents just bought it last year for $250,000, they look at the house and say, oh, it's worth $300,000. Now right away you're like, well, that's awesome, they made $50,000 in value. Well, yes and no. They didn't do anything to the house to increase the value, it's just a result of inflation. And here's the sucky part, the tax guy is going to tax them based on the $300,000 house, and they're going to look at it and say, oh, look, the value increased by $50,000. You have to pay more taxes. Yeah, that kind of stinks. So the tax thing will affect not only individual homeowners and consumers, but it will also affect businesses. And the same thing is that when they own stuff and the government comes in and looks at it and says, oh, it's increased in value, but I didn't do anything to it. It's actually more worn down than it was last year. No, it's increased in value, so now you have to pay more taxes on it. All right, the last point that I wanted to make with inflation is that inflation oftentimes is expected, and we do expect some inflation. But the question is, how much inflation do we actually expect? And if it becomes unexpected, then it is going to hurt people that aren't planned for it, or they don't pay attention to it. So I have this cartoon here where I have this nice, robust economy that's blowing into this balloon that you can't read it, but it says inflation. And it continues, so the economy continues to blow into the balloon. If it continues to do that, it's going to eventually have the inflation suck the life out of the economy. So the intention here and the idea here is that you have to keep in mind inflation when you're planning for the future, because prices will rise, and if you don't take it into account, you're going to be on the crap end of the stick. All right. That's all I have for this video. In class, we did do an activity that looked at different people that were helped and hurt by inflation. I would encourage you to take a look at the list. I will have the cases on Canvas. It is a worksheet that I will be picking up, so I would encourage you to take a look at that. If you have any questions, let me know.